Welcome, fellow Canadians. The Tax-Free Savings Account, or TFSA, isn't just a savings account, it's arguably the most powerful investment vehicle available to us in Canada. Designed to help you grow your wealth completely tax-free, it's an incredible opportunity. Yet, despite its immense potential, I consistently see individuals making simple, avoidable errors that cost them thousands, if not tens of thousands, of dollars. These mistakes can erode your hard-earned savings and undermine your financial goals. In this video, we're going to dive deep into the 7 most common TFSA blunders. More importantly, I'll show you exactly how to navigate these pitfalls, ensuring you're getting every possible benefit from your TFSA and truly unlocking its full, transformative power for your financial future. Before we jump into the mistakes, let's quickly recap what makes the TFSA so extraordinary. Introduced in 2009, its core principle is simple: any investment income earned within the account, whether it's interest, dividends, or capital gains, is completely tax-free, for life. This means you keep every penny of your growth. Your contribution room accumulates every year you are 18 or older and a Canadian resident, even if you don't contribute. It's not just for saving, it's for investing. This makes it incredibly flexible, suitable for short-term goals like a down payment, or long-term dreams like retirement, all without the tax drag seen in non-registered accounts. Understanding these fundamentals is your first step towards leveraging its power correctly. The very first, and arguably most costly, mistake many Canadians make is overcontributing to their TFSA. This means you've put more money into your account than your available contribution room allows. The Canada Revenue Agency, or CRA, takes this very seriously. The penalty is a steep 1% per month on the highest excess amount in the account for that month. What often happens is people overcontribute accidentally and don't realize it for months, sometimes even over a year, leading to penalties that quickly snowball into thousands of dollars. It's a silent killer for your savings, transforming your tax-free gains into a tax liability. This penalty isn't just a slap on the wrist, it's a significant drain on your financial resources that could have been avoided. Calculating your TFSA contribution room can feel a bit like solving a puzzle, and it's where many get tripped up. Your total available TFSA contribution room is a dynamic figure. It starts with the annual dollar limit for the current calendar year. To that, you add any unused contribution room carried forward from previous years. Crucially, you also add back any withdrawals you made in the previous calendar year. Finally, you subtract any contributions you've already made in the current calendar year. For example, the maximum cumulative room for someone who was 18 in 2009 and has never contributed, up to and including 2026, stands at $109,000. Annual limits, like the $7,000 for 2026, are indexed to inflation and announced by the CRA each fall. It's vital to understand this formula to stay within your limits. Here's a crucial pro tip to avoid overcontributing: always verify your exact TFSA contribution room directly through your CRA My Account online. While your financial institution might show you a figure, the CRA's record is the definitive one. It's especially important to remember that the CRA's online data can sometimes have a delay, particularly in the early months of the year. Contributions made late in the previous year or withdrawals might not be fully processed and reflected in your online account until after tax season, typically around April or May. So, if you're planning a significant contribution early in the year, it's safer to wait until your CRA My Account shows the most accurate, updated figure. When in doubt, err on the side of caution or consult with a financial professional. The second major mistake is treating your TFSA like a regular bank account, a place for frequent deposits and withdrawals. Its name, Tax-Free Savings Account, unfortunately, often misleads people into thinking it functions like a basic checking or high-interest savings account. While you can withdraw funds, the TFSA is primarily designed as an investment vehicle for long-term growth. Constant movement of money in and out creates a complex tracking nightmare for your contribution room. Many individuals fall into the trap of withdrawing funds and then immediately recontributing, only to find they've accidentally overcontributed because they misunderstood how withdrawal room is replenished. This frequent activity undermines the very purpose of the TFSA, which is to allow your investments to compound untouched over time. This rule is critical and frequently misunderstood. Any amount you withdraw from your TFSA is added back to your TFSA contribution room, but not until the beginning of the following calendar year. This means if you make a withdrawal in, say, October 2026, You cannot recontribute that same amount back into your TFSA in 2026 without risking an overcontribution penalty, especially if you were already close to your limit. You regain that withdrawal room on January 1st of 2027, alongside any new annual contribution room granted for 2027. This following year rule is what trips up so many people who treat their TFSA like a transactional account. Plan your withdrawals carefully, knowing that any money taken out won't free up space for recontribution until the next year. Beyond the risk of overcontribution penalties, treating your TFSA like a bank account has another, more subtle but equally damaging consequence: it severely limits the power of compounding. Compounding is where your investments earn returns, and then those returns themselves start earning returns. When you frequently withdraw money, you're constantly interrupting this growth cycle. You lose the opportunity for those funds, and the gains they would have generated, to compound tax-free over time. The true magic of a TFSA unfolds over decades, as even small, consistent contributions, left untouched, can grow exponentially. Frequent withdrawals strip away this potential, turning what could be a powerful wealth-building tool into a less effective short-term savings vehicle. Here's a more advanced, but equally critical, mistake: engaging in day trading or highly speculative, frequent trading within your TFSA. While a TFSA allows you to hold various investments, the CRA has strict guidelines on what constitutes carrying on a business within a registered account. If your trading activities are deemed to be a business, rather than simply investing, the gains generated are no longer considered tax-free capital gains. Instead, they become fully taxable as business income, effectively stripping your TFSA of its primary benefit. This is a complex area, and the CRA evaluates each case individually based on several factors, which we'll discuss next. The safest approach is to use your TFSA for long-term investment strategies, not for frequent, short-term speculation. How does the CRA determine if your trading activity crosses the line into business income? They look at several indicators. Firstly, the frequency of your transactions is key. Many trades over a short period raise a red flag. Secondly, the holding period of your securities: are you buying and selling within days or weeks, or holding for months and years? Thirdly, your knowledge and experience in the securities market and the amount of time you dedicate to your trading activities. They also consider the financing involved, and if you advertise to solicit clients. If these indicators point towards a systematic, business-like approach, your TFSA could be reclassified, leading to significant tax liabilities and potential penalties on past gains. It's a risk not worth taking with your tax-free growth. Mistake number 4 is holding ineligible investments within your TFSA. Not everything can go into a TFSA. The CRA specifies a list of qualified investments such as publicly traded stocks, exchange-traded funds, ETFs, mutual funds, GICs, and government or corporate bonds. However, holding non-qualified investments like real estate, shares in private corporations where you have significant interest, non-arm's length transactions, or certain types of foreign property, will trigger severe penalties. The penalty is generally a 50% tax on the fair market value of the ineligible investment at the time it was acquired. Additionally, any income earned from that ineligible investment is fully taxable. Always ensure your investments are qualified to avoid these significant tax hits. To ensure you stay compliant and avoid harsh penalties, a simple pro tip is to stick to the most common and widely recognized qualified investments. These include stocks of companies listed on designated stock exchanges, widely available exchange-traded funds, ETFs, and professionally managed mutual funds. Guaranteed investment certificates, GICs, and even high-interest savings accounts offered by financial institutions are also perfectly acceptable. If you ever have any doubt about a particular investment's eligibility, always consult your financial institution or the CRA directly before placing it in your TFSA. The vast majority of Canadians can build substantial wealth using these standard qualified investments without ever needing to venture into more obscure, and potentially problematic, asset classes. Simplicity here is your ally. On the flip side of the spectrum from day trading, another costly mistake is playing it too safe with your TFSA, effectively underutilizing its incredible growth potential. Many Canadians treat their TFSA as just another savings account, holding only cash or very low-interest guaranteed investment certificates, or GICs. While these are safe, they often provide returns barely keeping pace with inflation, meaning your money isn't truly growing in real terms. The real power of the TFSA lies in its ability to shield growth-oriented investments, like equities, equity-focused ETFs, or growth mutual funds, from taxation. By opting for only cash or low-return GICs, you're missing out on the compounding power of tax-free capital gains and dividends, which can build substantial wealth over the long term. Consider your investment horizon and risk tolerance to truly maximize your TFSA. Let's put the power of tax-free compounding into perspective. Imagine contributing just the current average annual limit of $6,000 to your TFSA every year for 30 years. If that money only grew at a conservative 1% per year, you'd have around $210,000. Now, imagine that same $6,000 annual contribution, but invested in a diversified portfolio yielding an average of 7% per year, compounded tax-free. After 30 years, you could accumulate well over $600,000. That's a difference of nearly $500,000, all tax-free. This illustrates why choosing appropriate growth investments is so crucial. The longer your investment horizon, the more significant the impact of that tax-free compounding becomes. Don't let your TFSA sit idle, make it work hard for you. The sixth common mistake, and one that often gets overlooked until it's too late, is failing to designate a beneficiary or a successor holder for your TFSA. Without proper estate planning for this account, your TFSA could be tied up in probate, incurring unnecessary fees and significant delays in transferring assets to your loved ones after your passing. Worse, without a designated successor holder for spouses or common-law partners, the TFSA could lose its tax-free status post-death, leading to tax implications for the inherited assets. A TFSA is a powerful tool in life, but its benefits can extend beyond. Ensuring a smooth transition to your chosen beneficiaries is a simple yet profoundly important step to protect your legacy. It's vital to understand the difference between a TFSA beneficiary and a successor holder. A beneficiary receives the funds from your TFSA upon your death, but these funds are typically paid out to them, and the TFSA account itself ceases to exist as a tax-free vehicle in their hands. They then have to integrate these funds into their own financial planning, possibly contributing to their own TFSA if they have room. A successor holder, however, can only be your spouse or common-law partner. If designated, they essentially step into your shoes and become the new account holder, taking over your TFSA, and crucially, maintaining its tax-free status without impacting their own contribution room. This seamless transfer is an invaluable benefit for couples, preserving the tax-free growth potential for the surviving partner. Ensure your designation aligns with your family situation and estate goals. Finally, the seventh mistake, and perhaps the most pervasive and truly regrettable, is simply not using your TFSA at all. Many Canadians, for various reasons, whether it's feeling overwhelmed, not having enough money, or just procrastination, let years go by without ever opening or contributing to a TFSA. Every year you are 18 or older and a Canadian resident, you accumulate contribution room, regardless of whether you use it. By not contributing, you're missing out on years, even decades, of incredible tax-free growth and compounding. This is literally free money left on the table. Even starting with small, consistent contributions can make an enormous difference over time. Don't let the perfect be the enemy of the good. Begin leveraging your TFSA today, even if it's just with a small amount. For those struggling to get started or maintain consistency, here's a powerful pro tip: automate your TFSA contributions. Set up a pre-authorized contribution (PAC) from your bank account to your TFSA every paycheck, or on a specific day of the month. Whether it's $50, $100, or more, automating these transfers ensures you're consistently contributing without having to actively think about it. This set-it-and-forget-it approach is incredibly effective for building wealth over time, leveraging the power of dollar-cost averaging and making saving effortless. It removes the temptation to spend the money and keeps you disciplined, turning your good intentions into tangible financial progress. Even seemingly small, regular amounts can accumulate into substantial tax-free wealth over the years. Let's quickly recap the crucial mistakes we've covered today to ensure you maximize your TFSA. Firstly, never overcontribute. Always check your CRA My account for your accurate limit. Secondly, don't treat your TFSA like a bank account with frequent ins and outs, as withdrawals only replenish room in the following year. Thirdly, avoid day trading to prevent your gains from being reclassified as taxable business income. Fourth, only hold eligible investments to dodge severe penalties. Your TFSA is a powerful wealth-building tool, and understanding these fundamental rules is your first line of defense against costly errors. By simply being aware and planning strategically, you can protect and grow your tax-free wealth effectively. To truly get the most out of your TFSA, here are your actionable takeaways. Fifthly, don't play it too safe, use growth-oriented, qualified investments to truly benefit from tax-free compounding. Sixth, designate a beneficiary or successor holder to ensure a smooth, tax-efficient transfer of assets. And finally, the most important action, start using your TFSA today, even with small, automated contributions, rather than leaving this incredible opportunity untouched. Make it a habit to review your TFSA strategy regularly, especially as your financial situation or goals change. Your TFSA is a dynamic account that, when used wisely, can be a cornerstone of your financial security and future prosperity. Take control, stay informed, and let your TFSA work for you. Thank you for watching. If you liked this video, please like and subscribe.